Hello and welcome to a Alphi educational video, the first in our series on Roth conversions. So today we're going to break down what I think is one of the most important things anybody can do heading into retirement, and talk about probably the single most important account you can have, and more importantly, how to actually make it useful to you, because there's a lot of limits on how much capital you can put into it. Those limits are the amount you can put in, and sometimes those limits have to do with income as well. And so we're going to explain the Roth account, and we're going to explain how to really get a lot of money over into it in the way it's best going to help you in your retirement.
Yeah, a lot of good content to cover. And so kind of before we get too nitty-gritty into it, I guess we could start off just by briefly explaining what a Roth actually is, in addition to that, like what a Roth conversion is, and why someone would be using that in the first place.
Yeah, and feel free to add into anything I'm saying. So you pretty much have three types of accounts. You have tax-deferred accounts, where all the money going into them has never been taxed, and all the money coming out is fully taxable as income. And this can have significant impacts on you in retirement because of the provisional income calculation that determines how much of your Social Security is taxed. The money coming out of tax-deferred accounts like your IRA, 401k, that all impacts that. That money can also impact what's called IRMAA, which is just the determination on how much you have to pay for your Medicare, Part A and Part B. And so sometimes in retirement, you could actually end up taking a large chunk of money out of those tax-deferred accounts, and it could increase your premium payments for the next 2 years. And I've seen it hit $10,000, $15,000 of additional payments over that period of time. So it can have an impact. So that's your tax-deferred accounts. Then you have what's called non-qualified accounts. Sometimes those are titled in your living trust. Sometimes they're just called individual accounts, brokerage accounts. And these terms aren't necessarily technical. It's just what they're called by lay people. But truly, they're what's called non-qualified accounts. And those are accounts where money has been taxed and gone into those accounts, and then all your gains get taxed as either short-term or long-term capital gains. Now, one thing to note is that with a tax-deferred account, you can buy and sell assets in it all day long, and there's no taxable event until you withdraw money and take it out of the account. With a non-qualified account or one of these individual accounts or brokerage accounts, your taxable event occurs inside the account when you sell one of the assets that are held within that account. And so if you've purchased something and sold it within 12 months, that's going to create a short-term capital gain. All short-term capital gains are taxed fully as income. If you've held the asset for 12 months and a day and then you sell it, that generates long-term capital gain. And we'll have a video on this, but those are taxed at 0, 15, or 20%, just depending on their incomes. So again, the money coming from the first type of account I talked about, the tax-deferred account, the IRA, the 401k, things like that, that money coming out to you will also impact what your long-term capital gain rate is. Now, then you have a third type of account, the ultimate account, and it's the Roth. And so technically, it's also considered qualified like your IRAs are, but it behaves very differently. So I really think there should be a different terminology for it. But a Roth account, similar to the non-qualified, you're using money that's been taxed to put into it. The benefit to you is that none of your gains are ever taxed again. So obviously, if the government's going to allow you to generate or create wealth that can't be taxed, there's going to be a lot of restrictions on it. The biggest ones are just through your normal contributions into a Roth. I think last year, 2025, you're limited to $7,500.
Yeah, that's this year's. I think last year might have been 7.
Okay.
And this year it's been bumped up to 75.
Yeah. They increase it every year, and then you have an $1,100. If you're over 55, you have $1,100 catch up that you're allowed to do as well, bringing the total to $8,600. Now, I think a lot of people, if you're at high income, Well, now if you're high income too, you fall out of the ability to even contribute to a Roth. But I think a lot of people who are high income but not exceeding the threshold sometimes just don't look at the amount of money that they can put into it and really think it's going to be that much of a value over the long run. I don't know. That's just my opinion.
Yeah, 'cause it's quite a bit smaller than what you put in 401k.
Yeah, yeah. And so I see a lot of people who are, definitely able to be contributing to the Roth, and they're just not doing it for some reason. And so I always stress that should be the very. I think that account's more important to contribute to than your tax deferred accounts.
Yeah.
If I had a choice between putting $5,000 into a Roth or $5,000 into an IRA, I'm going Roth all day long. I don't care what your tax bracket is. There's no benefit you're getting today on deferring taxes on $5, $6, $7, $8,000.
Yeah.
That's going to matter to you more than building this account up and having this tax-free bucket to withdraw from later in life.
Yeah.
And I'm not giving you any numbers to back that up.
Yeah. So kind of going off that, I guess we kind of dive deeper into why the Roth is such a powerful tool once you get to retirement, as far as like the ability to, pull that money out, completely tax-free as opposed to paying tax like an IRA.
Yeah. So now this is where if you have a worthwhile financial advisor, CPA, or just you yourself, especially if you are like Nathaniel and you're born with the engineering mind that came from his father, you're going to be very capable of running your own numbers and handling this on your own. But one of the simplest, most effective tools in retirement is just the sequence or the withdrawal order on your accounts, right? So just being able to have a good grasp of these tax-deferred, non-qualified, and Roth accounts and determining where you're getting money from and how much. You might need $40,000 for a deck or a new car or a vacation. And the simplest thing you're going to go to, you're just going to withdraw it from an account. But if you put a little bit of work into it and you actually look at all your other incomes and what tax brackets you're falling into, you might come to the conclusion that it would be better for me to take maybe $20,000 from your IRA, $10,000 from a non-qualified, capture maybe you have some losses in that account, some positions that are down, sell them off, incur some losses, and then take the remainder portion of it from a Roth. And maybe all of that keeps your Social Security from being taxed at a higher level. I don't know. That might be an example. It'd be good to have a screenshot of.
Yeah, and I would agree that's probably the biggest benefit of a Roth is that it basically lets you manipulate your income in retirement to precisely avoid those like bumps in tax brackets.
Yeah.
Whereas, if you only got a brokerage account, an IRA, or a regular 401k, I mean, there's nothing you can really do about that. If you need that money for the deck, you're paying tax on all of it.
Yes.
Which can bump you way up into another tax bracket. You start getting taxed more on Social Security. Whereas even if you still have a regular IRA, a regular 401k, the ability to have that on the side, like a Roth IRA or a little bit of a
and it doesn't even take a lot, right?
Wow.
I tell a story all the time in my seminars of a client that was in the 12. They were at the very top of the 12% tax bracket, and they took an extra $10,000 out, and they took it from their IRA, thinking that would be taxed at 22%. And it triggered a number of these thresholds, and they ended up being taxed 35% on that $10,000. And you might not think that extra $1,700 is a big deal, but you just got taxed at the tax bracket of someone earning $500,000 a year, and you got taxed that in retirement with no W-2 income and on $110,000 of income. That's insane. That a retiree is getting bumped into the $500,000 a year earner tax bracket. In my mind, it is.
Yeah.
All right.
Yeah.
And so if you didn't have to, then why would you? Right.
Exactly.
And so all it takes is a little bit of forethought and planning ahead of time to make sure that you have this Roth bucket available to you. And like I said, it doesn't even have to be the majority of your wealth. I mean, I would try to make it that way. But even if you only had 25% or 20% of your assets there, just the ability to pull little bits out in order to manage your tax bracket, I think would be a powerful move.
100%. Yeah, I think some people get so, I don't know, I guess used to the idea of having to pay tax.
Yes.
that when a situation like that comes up and they got paid an extra $1,700, they just shrug their shoulders, and it doesn't have to be that way.
Oh no, and even worse, at the end of the year, what does your accountant tell you? Well, you had to pay all these taxes because you have all this money and all this income. You should pat yourself on the back and feel good about it. What? Yeah. No, thank you.
Yeah, I agree. All right, so let's kind of transition more into the actual Roth conversion.
Sweet.
Like, how does that process work,
Right.
and what are kind of the benefits of it?
So this is one of the most beautiful aspects of the Roth. And especially if you could enter the workforce young and know this, I think you could really set yourself up. And even if you hadn't, there's still a lot here we can do for you. All right. So in 1996, when Senator Roth proposed this legislation, one of the things that they did is they created the opportunity for people who hadn't had the opportunity to put into a Roth to do what's called a backdoor Roth. And that's just to be able to convert money from a tax-deferred account like your IRA over to a Roth. Now, just like when you put money into a Roth, it has to be taxed already. So when you take that money from your IRA and you move it to the Roth, you're going to incur the taxes on it. But all growth from there on out is never taxed again. And I have a spreadsheet that one of our CPAs ran for us for a client who was looking at converting $760,000 out of an IRA to a Roth, and they ran it every which way possible. They even did a very elaborate calculation to determine how much needed to come out of the IRA in order to, at a certain rate of return, prevent her RMDs, the recorded minimum distributions, from ever triggering a tax on her Social Security. And even doing it that way, nothing beat converting the entire IRA in 1 year over to the Roth. And that, I think, just has to do with what's called time value of money. The sooner you can get that money into a bucket where it's growing and is never taxed ever again, the better off you are. But there's some psychological barriers that prevent people from doing that.
Yeah, psychological. And then, there's psychological benefits to it too, just the certainty that you have in retirement, knowing that, all of a sudden now you don't care if there's rumors about federal government increasing taxes.
Yeah. All that's off the table. Yeah. And I'm going to throw a bunch of financial advisors on the bus here real quick. One of the questions I love to ask in our seminars is how many people's financial advisor has ever sat them down and modeled a Roth conversion for them? And you've been to a couple of them. Have you ever been there when I asked this question?
Yeah.
I have only, out of a room of 30 people, I'm lucky to get one person that's ever had this happen. And so my next question is why? It is hands down absolutely the best place you could have money. It is not up for debate. So why is your financial advisor not sitting you down and convincing you to convert your IRA money to a Roth?
I feel like that comes down to...
Remember, they're a fiduciary.
Well, exactly that. Like, I think it definitely just comes down to, yeah, they're working to do what's best for you, but at the same time, they're not incentivized or really care about actually going above and beyond, because they can do what's best for you within your IRA or 401k, and they could argue, hey, we're doing what's best for you. We're investing that money how you want it to be invested, or how we think is best for you.
Yeah.
But they're not going to take that a step further and be like, hey, looking forward to your retirement, let's really look at the tax side of things.
Over the next 10, 15, 20 years, right?
Yeah.
And I'm going to go one step further, and I'm going to be highly critical of my industry. I think it's because nobody wakes up every morning and thinks to themselves, how can I reduce my paycheck by 30%? And if I took all my clients' IRA money and convinced them all to convert it over to a Roth, and I don't have the strategies that we have available to us, they're going to have to pay close to 30% in taxes. Now, I can model it for you and show you how it's absolutely the best thing you could do in almost every circumstance. But they're not doing it. And I think they're not doing it because once you pay those taxes, that money's out of their control. They're not getting to manage it. They're not getting to charge their fees on it anymore. So they just removed 30% of the assets that they get to charge fees on. So are they really acting as a fiduciary in your best interest for you? I don't think so.
No.
And I think I can literally prove it mathematically. Because if they were, they would try and get you to do this.
Yeah.
And they would take the 30% cut. They would lose the portion to the government that they're getting to charge their fee off of. But instead, if they keep it all in those IRAs, hey, those taxes, that's your problem.
Yeah. Yeah, exactly.
I get to keep charging my fees on all that money that's going to go to the government later.
Yeah. Well, exactly that. Like, it's definitely a short-term gain for the advisor.
Yeah.
Because, like you said, as soon as they convert that money, that's a huge chunk of money off the table, and they're taking a pay cut for that.
Yeah.
Even though it, in almost all instances, is much better for the client.
Yeah.
But it's ends up being more work for the advisor.
Yep.
And then they end up making less, which is for him not really ideal.
No.
Especially when they can easily sell it to a client saying, hey, we're doing exactly what's right for you. Like no advisor feels like they have to do a Roth conversion.
No.
And it's easy enough to like maybe not lie to your client, but mislead them in saying that you're doing all you can for them.
Yeah. Yeah. And I think it's horrible. So.
All right. So kind of moving on. Now we've kind of explained the idea of a Roth conversion.
Yeah.
Let's get kind of into some of the rules behind
nitty-gritty.
it. So there's a couple different 5-year rules. There's one specifically about conversions, but not to be confused with the other 5-year rule that's for earnings within a Roth.
Yes.
Can you kind of explain how those rules work?
Yeah. So, one thing too, it's funny to me that I've been in this industry for a while, but I always admit when I don't know something or I'm wrong about something. What's interesting about a Roth is even though it's a retirement account, the contributions to it are always available to you penalty free. Okay. Now, but your gains are locked up until you're 59 and a half, or they've been in the account for 5 years. Okay. And every contribution has its own 5-year time frame. Yeah. Okay. And so with these rules, there's one that really kind of pertains to the 10% penalty, and there's one that pertains to taxation. Okay. If you take your gains out before that 5-year or before you're 59 and a half, you're going to pay taxes and you'll pay the penalty. Right? Am I wording that correctly?
Yeah. If you're under 59 and a half, you're taking within 5 years. If you're taking within 5 years, you got to pay the tax on it.
Yeah.
It's got to sit in there 5 years.
Yeah. And you're going to pay the 10% penalty on the gains.
Yeah.
You won't pay the penalty on the principal, on the contribution.
Yeah, correct.
Yeah.
That money is yours because you already pay tax on it, so the government doesn't care as much about it.
Yeah. Yeah. And so you don't even have to wait till you're 59 and a half to get that.
Yeah.
Okay. Is there more here that I'm missing?
No, just, if you're under 59 and a half, it's, within those 5 years, you got to pay tax. And 10% penalty. If you wait more than 5 years, no longer have to pay that tax. But, if you're still under 59 and a half, you're going to have to pay that penalty because it's a retirement.
Just on the gains.
Yeah, just
not on the
gains.
principal.
Principal, you can always take out anytime. You've already paid tax on that, so that money is yours.
Yeah. Yeah.
Still maybe not recommended, but you can.
Yeah. Yeah. And, if you've, well, we can get to that later, but if you've combined your conversion with a tax strategy that eliminated the taxes, well, 10% is better than what you would have taken it out at.
Yeah.
I still wouldn't recommend it, but.
And then moving on kind of the 5-year rule on conversion. So like, we'll say someone has an IRA, 200 grand, and they convert it to a Roth. There's a 5-year rule that kind of takes place for that money that they're converting. How does that work?
Yeah. So, again, the money you converted that you paid taxes on, that's accessible anytime, right?
Yeah. Within,
there's no 5-year rule on that.
There's a 5-year rule if you're under 59 and a half.
Yeah. If you're under 59 and a half.
But if you're over 59, no.
If you're over 59 and a half, the money you convert that you paid tax on is available.
Yeah.
Your gains, again, are locked up for 5 years.
Yeah.
Okay. But you don't really have to worry about it. I thought, and this was something else that we clarified in your research for this video, you don't really have to pay attention to it. When you make a withdrawal out of your Roth, it's all handled for you, correct?
Yeah.
Like even as an advisor, I don't have to.
Yeah.
I don't have to go in and select certain assets.
Yeah. Yeah. It'll always be principal, then conversions, and earnings. So it's like a built-in protection from the IRS. Because if you have 100 grand of contributions that you've made, and you say you have 100 grand of earnings, and you pull out 20 grand,
Yeah.
like
It's
the IRS protecting you, it's not going to pull 20 grand out of earnings. It's going to by default
Take it from the
contribution.
Yeah.
So there's never a penalty. There's never any tax.
Yeah. Yeah. So it'd be really interesting to think about a scenario where if you converted money to a Roth and then something really bad happened and you had gains and you had to take the whole amount out. But would that really hurt you? I mean, if it was still in your IRA, you'd be paying taxes on that money anyways.
Yeah, you're still going to be paying the same amount of taxes. If you really had to take it all out, you'd be paying the same amount of taxes to take it out of your IRA.
Yeah. You're not going to pay double tax on the principal that you already paid tax on. Yeah. You're just going to have to pay taxes on what you thought was going to come out tax-free because you withdrew it before the 5-year period.
Yeah.
But you would have paid those taxes on it if you had left it in the IRA.
Exactly. Like it's still.
So I don't know of any scenario that could ever occur.
Yeah, where it's not a good idea.
Yeah. I mean, really, I've thought about this a lot. Even if you converted it and then died, well, your heirs now reap the benefits.
Yeah, that money can sit there for as long as
10
they want,
years,
and then
not as long, 10 years. The
10 years,
Secure Act changed it to 10.
But
they can let it
take it out at the end of the 10 years.
Yeah, let it grow for 10 years tax free.
They don't have to worry about taking that out yearly to try to minimize the tax.
Correct.
Whereas with if you get passed along the IRA, then all of a sudden you got to focus on how much I want to take out here, how much I want to take out this year, because you're going to be paying tax on it, and then that's in addition to whatever earnings you're making, because a lot of your heirs are going to be working age, and so there's a lot more thought process behind it. Whereas if it's a Roth, they can just wait, let it ride in that Roth for as long as they want up into the 10 years, and just take that all out because they're not paying tax on it.
Yeah. So I literally cannot come up with a scenario.
Yeah.
I mean, I literally can't think of one.
Yeah.
In which it would have been better not to have converted.
Yeah. I would agree.
So feel free to some mathematical spreadsheet genius out there try and come up with a scenario in which we're wrong, because I'd love to see it. It'd be beneficial.
Yeah. I think it's great. I think it's great that everybody's investing regardless, IRA, 401k. I think these conversions are great. I think a lot of people will be better off just starting off by contributing to a Roth. But, a lot of people were never really taught the true benefits of Roth.
Correct.
It's one of those things that's like better late than never.
Oh, absolutely. There's never a bad time to start putting money into Roth. And if you have a 401k at your work, you should really look at that plan, because a lot of 401ks have a 401k Roth option. And I'm pretty positive 401k Roth options have higher contribution limits into the Roth.
Well, it's definitely effectively a lot bigger because, you're putting after-tax dollars in.
Yep.
Which ends up being way more when you think about it than tax-deferred. Because if you're maxing out your Roth IRA, the amount of money you get in retirement is significantly more.
Oh, yes.
Than what you get put in a 401k. Because you're going to be paying a huge tax bill in retirement.
Yeah. In fact, it's one of the least thought about aspects of it. Somebody once said to me, when people print out their net worth statement, why do they never show that 30% of that's not theirs?
Exactly. Because like your net worth can change a lot at the same dollar amount for different people. Because someone might have a ton in a Roth, some might have a ton in a 401k or IRA.
Yeah. Think about that, right? If I have $1 million in an IRA and I have $1 million in a Roth, my net worth statement is going to say the same amount.
Yeah.
And yet it is absolutely not the same amount.
Way different.
Yeah.
Way different. And then in addition to that, the flexibility you get is just, a huge benefit.
Yeah. Now, I would also tell you this, speaking of making extra work for myself as a financial advisor, there are annuity companies that will allow you to convert your annuity even after your annuity is already in place, from an IRA to a Roth annuity. So, of course, as a financial advisor, you got to call the company and find out if they can. And
It's always more work, but
it's always more work, but it's worth it.
yeah, it kind of separates the average financial advisor from like someone who's actually doing their job well.
Yeah, yeah.
So we basically covered a lot of different topics I had on this list.
We probably
Last
didn't go in
few minutes
order,
here.
did we?
So we can pretty much get to where we're wrapping it up. Are there any final notes or maybe like common misunderstandings about Roth accounts or Roth conversions in general?
I think the 5-year rules are misunderstood. I know I misunderstood them for long, even when I thought I had an understanding of them, because technically even some people will tell you there's 3 different 5-year rules. And so the whole five, but I think the way you put those notes together, we should probably put those into the video.
Well, I'll link.
Yeah,
it.
makes it really easy to understand. Any that you think of?
Yeah, I think like people are just so used to. I think a lot of people don't even know how a regular IRA works, but then a Roth is like, I guess, an added layer of complexity. Just I think a lot of people don't realize they can take out their contributions. Not saying you should, but I think a lot of people don't realize.
Yeah. I thought that because it's a retirement account, even if you had paid tax on the money going into it, that would be locked up to your 59 and a half. And I'm in this business, and I have the, what are considered to be the highest licenses there are.
Yeah, but maybe that's a good misunderstanding because most people should not be touching their money.
Absolutely, yeah. So again, right, like the default in order of withdrawal is to let this money that's tax-free grow the longest period of time.
Yeah.
And so, but again, one of my mentors always told me that there's effective, less effective, and more effective. And so putting money into a Roth is more effective than not. And letting it grow is effective as long as possible. But then to add that thought process to how much of the money you need should come from which of these taxable or non-taxable accounts is even more effective.
Yeah, that's the most important detail.
Yes.
Because even if you have the Roth, you still have to be aware of which accounts you're pulling out of in retirement. Because like at a certain point, there's no more benefit to drawing more from your Roth if you can draw from your 401k
Correct.
or a brokerage account up to a certain tax bracket.
Yes.
Because you want to draw as much as you can out of those accounts up until the point where you're about to get bumped up in tax. And then you fill in the rest with Roth. And then that way your Roth stays healthy as large as possible.
Yeah. I had a client want to, give their son some money as a gift. And they asked me if they should give it from the Roth. And I damn near had a heart attack.
Yeah.
It's like, what? No, definitely not. Like, and again, maybe that's my biases and emotion factor my decision, and maybe it'd be better to look at all their different sources of income and again, do this deal from, but to me, that Roth money is the most valuable money you got.
It's the most valuable.
And if you want to give somebody some money, get it from somewhere else.
Yeah. Cause it's like, not only is it, some account that's old tax-free money, but it's really like a tool.
Yeah.
Because that is money that you can use to manipulate your taxes. So it's like having that Roth in place is a good start. But from there, have an advisor or at least yourself know how much to take out of it.
Yeah. And so you hit something really important I want to go back to. You were saying, and I forget your exact word, but it was just a couple seconds ago about if you, like you said, that you can get to a point to where if you took, let's say you were going to 10 grand out of the Roth, kept you in a certain tax bracket, but you did 20 for some reason. Well, that last 10 didn't help you.
Yeah, there's no benefit to it.
And so here's the problem with that. Extend that out. Let's say you take too much out of the Roth too many times, and now you don't have it. Now you don't have that bucket to manipulate your tax brackets and to combine with other incomes. And now you're just forced into taking everything from a tax-deferred account.
Yeah.
So it's crucial that you're very, very efficient and effective with withdrawals from a Roth. Because most people, due to the contribution limits and the income caps, don't have a significant amount in their Roths.
Yeah. Yeah, exactly. It's like, some people might only have 20% of their net worth or 25
Yeah.
in a Roth. And in reality, for most people, that's plenty, but not if you're going to be using more than you need in retirement.
Exactly.
That's like
correct.
an easy way to drain the account.
Yeah.
For no real added benefit.
Yeah, exactly. Right. And so after you watch this video, you're definitely going to watch, I think we're going to do a separate video on the most magical thing in the world. And that's how to get your money from your IRA and 401k over to a Roth without losing 30% of it to the government.
Yeah.
And now you're talking about some real money.
Yeah. So that one will tie very heavily into this, and the synergy between those two, very solid.
Yeah. Yeah. And so I always tell people, if you're young and you're working a job and you have the 401k, go ahead, get your full corporate match.
Yeah.
But instead of contributing more than what's getting you the match. So if they say if you put 6% of your paycheck in, we'll match 3%, do that. But I see people all the time that they're putting 10 or 15 in. Well, don't do that. Take that extra that you're doing into your 401k that's not getting you a corporate match and put that into a Roth.
Yeah.
Or put it into another non-qualified bucket of money that'll enable you to do a tax-free Roth conversion later, which we'll talk about in this next video. So it's important that everything just goes back to planning, man, right? You fail to plan, you plan to fail, right?
Yep.
And so if you were young and you were starting off and you did this right, you contributed just what got you your corporate match in your 401k, you then second maxed out your Roth, and then third, you put money into a non-qualified brokerage account. When it came time to, at 59.5, when the 10% penalty falls off the qualified assets, the IRAs and the 401ks and stuff like that, you will be in a really good position to make use of some other tax strategies to convert that 401k and IRA over to your Roth without having to pay as much tax on it. And now you're really cooking with gas, as
it's a beautiful
previous generation liked to say.
Yes.
Hey, son, now we're cooking with gas.
Pretty hip, I'd say.
That's right. So anything else you want to throw in here?
No, I think we covered everything.
All right, cool. Well, hopefully this is the start in a long series of educational videos. If you have any suggestions for us, feel free to hit us up. We have a pretty long laundry list of topics we're going to go through, but we're always open to taking suggestions. So this is Elliot.
Nathaniel.
Signing off.